Hey there, guys. How are you doing today? Today is a great day on Friday since it's like nice and breezy out, and I have my window open in my room with the fan blowing some of the cool air in. To this week has actually been a very profitable week, and it's been really good. And I'm pretty much you can notice that I'm actually almost out of the negative from earlier this week, from all that stuff from the turbulence of the volatility on the market. But pretty much if we have another profitable week next week, then I'll be out of the negative and I'll be back in the positive on my portfolio value. So I'm pretty close to $350 from what I placed in. So the good thing is that Coca-Cola, AT&T, Hormel Foods Corporation, and Southwest Airlines are actually really doing well from what's been going on. Even though on Coca-Cola for today, even though they were a lot in the red at certain points, um, it's still coming out positive anyways from a 7% return so far from having this. AT&T is pretty much a little bit in the red from earlier today, but it's not that bad. Hormel Foods Corporation, they pretty much tried to stay in the green, and it's been going very well so far. Even though it's only small gains, it's pretty much worth it. Since I have almost 2 shares with them. Bank of America, I have 2.5 shares with them, but they were pretty much in the positive today. But the only thing is, I have to wait until their price goes back up by another few dollars, and then I'll be back in the positive on that. Because this one's the only one that's like dragging everything else down, but the rest of them are cushioning Bank of America until it can work its way back up. And then Southwest Airlines, I mean, I was just pretty much surprised about this because I bought this back on August 20th and I've had it for about more than a week now, and it's already up by a few dollars already, which is not bad at all, even though it's underweight from that. And it's had almost a 4.5% gain just from within 10 days of it. So that's not really bad at all from what happened. Because my average share price was $50.08, and it cost me $52.32, and it pretty much it's back at the same price from what it says here on my cost. But somehow it's saying that it's still in the positive by a few dollars, which is pretty weird, honestly. But it's only around 1 share that I got. Now, for this whole portfolio, my goals on this are pretty much I want to try and get at least $100 worth of dividends or more within each of these companies. So it's going to require me like thousands and thousands and thousands of dollars to be able to fund that for each quarter. Because once these pay out each quarter, then we'll pay $100 out each quarter, which is pretty much around $400 from each of these each year. When that's compounding like that, you can take like around $400 times it by 5, and it's about $2,000, roughly $2,000 each year from these doing that. So then that way I don't have to keep funding this portfolio or anything. The only thing I need to do is just keep track of the quarterly and the annually of the reports, basically, that they would send out. So pretty much everything has been going up, even though I've been funding it every so often from what you see here since like early July until now. But once it got around to where it's at the top there, I didn't fund it any more further than that afterwards, and it's actually been like going up and down a little bit, but now it's going back into the positive. So it can go back into what the net cash flow is from what I had there originally, and then I'll be in the positive in my overall amount, basically. So basically that's one of my goals, but there's also rules that I go by as well from investing. Like I'm basically doing my own thing for like some set of rules that I'm placing for myself. Say for like an example here, I have Coca-Cola and Hormel Foods Corporation. They're both consumer defensive type of investments, but this is packaged goods, and Coca-Cola is a non-alcoholic beverage. So basically, if I'm investing in stocks, it's okay to have some of the same stocks under the same sector, but they have to be different ones of the same sector. So that way, nothing is dragged down when something happens in each sector with certain companies. So if I had a financial stock for that sector anyways, Bank of America is a bank. So say like, oh, excuse me. Anyways, say like you have Bank of America, and then you want an asset management company. Say like you want like Charles Schwab in your portfolio, for example, if they were like a good buy or something, then I would basically get that and then not invest in another company like that. So that way, if you go and you invest in multiple companies, you won't get like really heavy in like any sector or anything like that. So say like for Southwest Airlines, for an industrial, for example, this is already an airline that I'm investing in. Say like if I go and I get like John Deere or something like that, it's an equipment for something like that. And then say like what if General Electric really shot up afterwards, if something good happened with the company and it started growing again, then I would have that for something else as well, and then I would have those three companies to invest in if they were like good. Well, I would have this and those two other companies to invest in if it was something good. But yeah, basically I go by that when I'm investing. So the other rule that I have for investing is avoiding cyclicals for a reason. Well, consumer cyclicals. Because even though it's like good for growth stocks and all that, eventually they're going to become like way too expensive, and then you won't be able to afford it. So if you're if you're somebody who got McDonald's in the past for like a much lower price and held on to it ever since, I mean that's a stable company, but the downside of it is that cyclicals actually get hit pretty hard if you're not careful with what you're investing in for a certain company, because it can get hit pretty hard like some other growth stocks like Amazon or some other companies that don't pay like dividends, and they're just strictly growth oriented and not paying dividends or anything. They just take the money and reinvest it back into the company from what they get from investors. So that's a second rule that I go by. Well, another rule I go by, basically. I don't try to invest in cyclicals besides trying to watch my sector weighting. And the other thing that I do is I make sure that I I don't go for like loser stocks or anything like that, because like at one point I actually considered buying Kraft Heinz because of how low it is, but eventually it's going to wind up like GE or General Electric Company, because the price is going down so much that I don't know if it's going to bounce back or not from what's going on. So basically, those are the kind of rules that I follow. I just make sure that I don't mess up with single stocks, basically. Now, for exchange traded funds, however, the rule that I have with that is just pick one fund and just stick with it. Don't get like a whole bunch of them where you're spread out way too thin. Because when I used to use the Acorns app, typically what happened was that I did not know that they had bonds that were overlapping with some of the companies. If you had like a moderate portfolio which had the LQD bond or the iShares bond for what it was. Let me stick this to funds. LQD. And you look at the targets here for first two. The second one I don't know, but then there's Verizon Communications Inc., and that's actually in the S&P 500 ETF for Vanguard. So typically you're like going and overlapping and you're putting your money into these bonds. And I always avoid bonds for a reason. I mean, some people think they're better to invest in, but those people that did that during the trade war, they kind of screwed up pretty badly, because now what's going to happen is, even though the bonds were really shooting up, once that's all done and over with, when the trade deals are made, that whole entire bond's going to completely deflate. And even though they'll get more money out of it, they're going to lose a lot of their money as well for however much they stuck in beforehand. Even though they'll get more dividends out of it to adjust the price and all that, but it's really slow growth on that. I mean, honestly, I would just pick something like this, for example, the Vanguard S&P 500 ETF, which is VOL. I mean, this is all you need for your one-stop shop on investing, because it's already got non-US stock in it. It's already got cash in it, and most of it is domestic US stocks. So all you really need is just to dump a bunch of money into this from buying shares at the right time. Like right now, it's on the high end of things. But if you get caught it on its lowest week, which is $214.83, then yeah, I would buy like, I don't know, 5 shares if you have the money for it to afford it. And then you'd get like $25 a year from doing that for their dividend yield. But it's paid out to you each quarter on this. And then they got stuff like Microsoft Corporation, Apple Inc. But the difference with this is that it cushions itself. It's kind of like how I have it in my portfolio here. Only it's with over 500 other companies in that. So basically, I would just get this because of the low expense ratio as well. And its price history hasn't been bad, and it's always been going up ever since it's been doing that. So no matter what happens, this thing is going to keep growing and growing and growing and growing. So basically, this is going to be like my plan B if my portfolio that I currently have right now, something bad happens with any of these companies or anything like that. Because for Coca-Cola, when I saw an interview with Charlie Munger the other day, which was from recently this year, some people were rumoring that Coca-Cola wanted to experiment with cannabis, and I'm just like, are they nuts? I honestly would not do that. That's just a terrible idea. So basically, as long as these companies are doing well, that's all that matters. But if something terrible happens with these, like a year or two later, then I'll just come to this ETF here and use it as a backup for like selling all my shares from however much I've gained out of it, and then just put it into this instead, even though it might be less dividends. being paid out each year. An ETF like this is more designed off of you getting your money back on capital gains rather than dividend payments. So it's pretty much different from what I'm doing right now. So anyways, if any of you guys have liked this video, give the video a like, subscribe, and turn on notifications so you know when I do my next video on Friday each week for each month. I don't care if it's a holiday or anything like that. I'm going to stay committed to that upload time date. And leave a comment below if I have left a question that was pinned down below in the comments. And share this video with anybody if you think it might be of any help from them learning while being entertained. But my disclaimer is I'm not a certified financial advisor, so if you do anything from doing anything on this video, you're liable for your own actions. So I would suggest seeking a certified financial advisor in your local area if you're deciding to do investing or anything like that. So I will see you guys later next week on the next Friday, and let's hope that next week will be another positive market gain, basically. So I'll catch you guys later.